Hello and welcome to Policy Watch. This week we focus on the aviation sector. The first foreign player to enter the domestic market, AirAsia, will finally be launching a joint venture with Tata Sons. That will be our top story. We will also touch upon other policy developments that happened through the week. And to discuss these stories, I have with me Priyaranjan Dash, Managing Editor of the Financial Chronicle. Many thanks, sir, for joining us in the studio once again. But before we get to the discussion, let's get you this week's top headlines. AirAsia Tata Sons JV on track. FIPB gives approval amid some divergence between finance and civil aviation ministries. Indian refiners might stop oil imports from Iran soon as sanctions by the US escalate insurance risk. And insurance regulator IRDA tweaks norms for insurance companies that want to invest in the government securities as well. Those were the headlines this week. Let's move into our top story of the week straight away. It's a full circle for the company that started aviation in India. The Tata Group is all set to return to the skies with its proposed joint venture with Malaysian budget carrier AirAsia, obtaining the Finance Ministry's nod for the joint venture. AirAsia will be the first foreign carrier to enter the domestic aviation sector with an initial investment of 800 million rupees. Here's a detailed report. Take a look.
Tata Group is set to return to the aviation business with the Malaysian budget carrier AirAsia obtaining Finance Ministry's nod for its joint venture. AirAsia's proposal to launch an airline jointly with the Tata Group was approved by the Foreign Investment Promotion Board today. AirAsia will be the first foreign carrier to enter the domestic aviation sector with an initial investment of 800 million rupees.
There are no problems, but they have to follow that procedure. Because the cabinet, they took a decision. The Commerce Ministry issued a notification that has to be followed, and FIPB will decide what the procedure. If they want to deviate from it, then let them decide it. They can always form a joint venture as soon as the Indian company gets NOC or starts operation.
AirAsia will have a 49% stake in AirAsia India, while Tata Sons Limited will hold 30% and Arun Bhatia of Telestra Trade Place will hold the remaining 21%. The airline can begin operations as soon as they acquire the regulatory permissions from the DGCA and Civil Aviation Ministry. The company is hopeful of starting flights as early as May-June. India's aviation industry, which has been plagued by losses due to high operating costs and fierce competition, was open to foreign investors in September last year. The FIPB clearance is likely to give confidence to other foreign players to enter the Indian market. Similar proposed JVs like the Jet Etihad deal that have been stuck for a while will also receive positive signals from the AirAsia venture. Budget airlines have cornered 54% of the Indian market, which is growing fast because of a huge middle class and very low penetration. The advent of AirAsia in the low-cost carrier segment is also expected to check any rise in fares over the next few years. Bureau Report, Rajya Sabha TV.
There you go. AirAsia all set to come to India and operate on intra-city routes. Mr. Dash, what do you think? The declining passenger traffic in the domestic aviation market, high operating costs as well. Now, that has led to sort of a slump in the domestic aviation market. Now, do you think the entry of a foreign carrier with 49% stake in a JV, coming into the fray and taking on the likes of, say, Indigo or SpiceJet, do you think that will at least galvanize the market or liven up competition at least?
Yes, it will definitely liven up competition. But, one should look at the recent history of foreign investment in the aviation sector, or rather the foreign investment policy, the way it has evolved. Now, if you recall, in 1997, during the United Front government, when Mr. C.M. Ibrahim was the aviation minister, foreign airlines were kept out of domestic carrier business. Now, the Tatas who wanted to come in with Singapore Airlines waited and had to give up.
Absolutely.
So that was, if you look at the development since then, the FDI policy has not only been ambiguous somewhat, and somewhat illogical.
Would you say it's restrictive also? That's been the criticism.
Exactly. It's been non-transparent. It's been opaque, and the implementation has been doubtful. So, for instance, at that time, at the time that the Tatas withdrew their application, there has been instances as to why they had to do this. and how one particular airline which had foreign carrier stakes had to even diluted to keep Tata's and Singapore Airlines out.
Right.
Now, to begin with, there was no logic when you allow foreign investors to invest in domestic carriers, not to allow foreign airlines to invest.
Absolutely.
It's like saying that you will allow foreign direct investment in steel, but you won't allow a steel company to invest.
Right.
Or a pharmaceutical company to invest in pharmaceuticals.
Makes no sense.
So, you not only, foreign investment is just not capital. It's also technology, it's business practices, and it brings in a lot of global expertise.
So would you say then there has been a lot of criticism on the comma issue, and of course the business papers carried that story that because of a comma, if the comma wasn't really there in the policy, this wouldn't have gone through. Now, would you say that also perhaps is indicative that it's such a highly interpretive policy, which also is a very restrictive policy?
It is, it's another instance where an attempt was made to make the policy ambiguous. Trying to say that, well, the new policy, which allows 49% stake by foreign carriers,
can only invest in existing airlines.
Yeah, can come in only in existing airlines and not in new that's nonsense. It doesn't make sense at all. In fact, when the cabinet decided this in September, although the immediate, the immediate reason given was the very poor financial health of some of the existing domestic airlines, which require foreign capital to come in for them to give them a fresh lease of life. But as we know, this proposal of allowing foreign carriers to also invest in domestic carriers has been there in the pipeline for years and has been argued by various expert committees and favorably, but that's been kept out. So in September, when the cabinet decided this, I don't think there was any doubt that the cabinet wanted to restrict it only to the existing airlines and not to new greenfield ventures. But the Civil Aviation Ministry, and in fact the minister, tried to convey an impression that, in fact, he went on record to say that we won't allow licenses for new greenfield airlines. We'll just allow the existing investment in existing carriers. That doesn't make sense. Now, FIPB has allowed foreign investment to come in, but it's the aviation ministry which will actually has to license the airlines to operate.
So it could still be quite a distance between the cup and the lip. Even now they have to get DGCA approval.
That will be unfortunate. That will be unfortunate if it happens.
Yeah.
See, India cannot afford these kind of policy flip-flops and lack of clarity and non-transparency in the aviation sector. We've had, there are stories floating around, and it is not good for any country to make it an attractive investment destination to have doubts in the mind of prospective investors.
Absolutely.
And
aviation is a big industry. We rely on that.
Exactly.
One of our boom industries.
We need to be the policy needs to be not only simple, but non-bureaucratic in implementation and transparent.
Absolutely. Now, assuming that this deal, it's semi-gone through, assuming that FIPB obviously has given an approval, assuming that DGCA gives them a license. Now, initially, AirAsia's plan, and according to Tony Fernandez, who is basically the promoter of the airline, he says that my strategy is to offer fares as low as 1,000 rupees. Now, the idea seems to be, as far as we can tell, to keep operating costs at the lowest possible, barest possible minimum. Now, there is also talk of the new airline, if and when it comes into being, they'll skip the very profitable and the very highly arterial Delhi-Mumbai route. Now, that's one of the most important routes that fly in India. Now, the strategy also seems to be that they want to stimulate the market with low-fare tickets until a high percentage of seats is achieved. Now, do you reckon that strategy can work in a high-cost environment like the Indian domestic aviation market?
Well, AirAsia has done it in Southeast Asia, from out of Malaysia. Now, AirAsia has said that they will make Chennai the hub. Now, if you look at the market from out of Chennai, the SpiceJet today has about 30% of the market, followed by Indigo. And Jet and Indigo more or less have a similar 20-21% market share out of Chennai. Now, that being the case, once AirAsia comes in, Clearly, both SpiceJet and Indigo, which are the existing low-cost carriers operating out of Chennai, they too have a similar route strategy, in terms of going to tier 2, tier 3 kind of cities. And AirAsia is coming in with that kind of, it's a low-cost carrier with a similar strategy. So it will be very interesting, and it will be, competition will be intense, and that's good for the market.
Do you reckon that it'll start a new kind of a price war? Already prices are being slashed all over the place.
Well, why not?
It could.
And if it does, there is nothing wrong with that.
Absolutely. So it's a win-win for the customer, basically. Yes. It's a win-win for the customer. Now, one structural issue that I want to talk about, most of us people who watch aviation as well, they say, critics and analysts say that just allowing foreign airlines or foreign carriers to come into the aviation market is not going to solve our deep-rooted structural issues that we have in our policy making and our implementation as well, as far as the aviation sector is concerned, domestic or otherwise. Now, and they say that we need a regulatory framework which is transparent, like you mentioned. Now, explain to our viewers, in layman's terms, what sort of a policy are we looking at? Of course, it should be transparent. Of course, it should be not involving red tape and all. But what kind of a clear signal can the government really give to give the right signal out, saying that, look, we are serious about aviation and we want it to grow by leaps and bounds?
See, in the last year or so, some of the issues have been addressed. The issue of aviation fuel, for instance, which is relatively expensive in India. Now that issue has been addressed to the extent that today, definitely the aviation fuel cost is much less than it used to be a year and a half ago. So to that effect, it has a cost reduction effect on all airlines. Number one. Number two is it's a highly taxed industry, relatively speaking. And that will be the case because aviation is a dollar industry. That is another reason why this distinction of not allowing foreign carriers to come into domestic carrier was illogical, because aviation is a dollar industry. It's an international industry. This case of calling, categorizing airlines into domestic airlines and international airlines also is quite artificial. So that being the case, aviation is, although the objective would be to let everybody take to the sky, so to say, but aviation would continue to be relatively highly taxed.
Right.
So there is no question about it.
So would you say then, Mr. Dash, that say this deal does go through and they start operating in India, other foreign carriers, say for example Tiger Airways, which is owned mostly by Singapore Airlines, also Etihad, the Jet Etihad deal is also on the pipeline, has been stuck for a very long time now. Do you think if this goes through, they could also be queuing up and wanting a piece of the Indian pie, and which is good for domestic aviation market?
See, at the moment, I don't think anybody is actually queuing up to come into the Indian market.
I'm saying if this deal goes through without a hitch.
Yes, of course. But I think that, there are issues, there are structural issues, like you said, with the Indian aviation sector, which the industry has to, but more than policy, or more than taxes, or more than costs issues resulting out of government policy, airport charges and things like that. Of course, those are issues that industry has to face. But industry has to look at its business model. It's more, I think, got to do with the way some of the airlines which have failed or on the verge of closing down or have been grounded, that's got more to do with the business model that they practice and than the environment as such.
Absolutely. So it could be company specific, because we have Indigo as well, which is doing fantastically well for us.
There is no question that Indian market is a growing market. It's a huge market for aviation, and there are millions of people who take to the sky, given a proper customer orientation of the industry.
Right. On that note, sir, we'll take a small break right now. We'll come back with the second segment and our second story, of course. Another very important story about Iran oil imports that perhaps could be halted. That's after the break. Don't go anywhere. Keep watching Policy Watch. Welcome back. India is set to halt all crude imports from Iran because insurance companies in the country have said refineries processing the oil will no longer be covered due to Western sanctions. The head of refiner MRPL said this week India is Iran's second largest buyer, taking around a quarter of its oil exports worth around $1 billion a month. Oil is Iran's biggest income generator, so a halt in sales to India would be a heavy blow for Tehran. Sanctions more than half the country's crude exports in 2012. In January, India itself imported over 286,000 barrels per day. In the first 10 months of the current fiscal year, India reduced Iran crude oil imports by nearly 22% on the year, data from trade sources have shown. Sir, it's not really very clear right now that why this has become an issue now. Sanctions were imposed quite a while back, actually. There were some problems. India did give some emergency insurance as well. But why now? Why are refiners pulling out now? I mean, is that surprising to you, that the timing of the situation, or was it really coming?
Well, it's been there, as you said, for quite some time. Since sanctions were, initially it was a problem of payment because, the channel of payments were disrupted. And so new channel of payment had to be right. looked at. But as you've mentioned, India has been bringing down its sourcing of oil from
It started when Pranab Mukherjee was finance minister. It started back then.
That's right. And I think last year itself, it's down by over 20%. 20%. The imports. And so, the thing is that basically, insofar as the US sanctions are concerned, India doesn't quite, and rightly so,
agree with them.
Agree with the unilateral sanctions. So, because Iran is its neighbor, and it's been a major source of energy supply to
Trade
India.
Partners, yeah.
And India has to look at its own interest. So it has to find way of importing crude. If it gets the best terms internationally from Iran, then why not? Now this is not exactly a fresh problem. Even the insurance problem has
it's about 6 months old.
Yes,
I think.
has been on the cards for some time. And if it is becoming debilitating now, then of course it will be difficult, or then India of course has to halt.
So what about companies like refinery like MRPL, Mangalore refinery, even HPCL, Hindustan Petroleum is the third largest buyer from Iran crude. Now what options do they really have? If Iran imports are stopped, how will they meet the requirements? Do they have options?
Well, some of the refineries are already switching to other crude. And that takes time, of course. It's not
setting up systems
yes,
and everything.
Yes, but that's been happening because it's been troublesome. So it's not been a smooth process of importing crude from Iran. No. Now this problem has come up. Either it has to be addressed, or refineries have to look for other crude.
So what really options could they really have? If not Iran, then other Middle Eastern countries then perhaps?
Yes, other Middle Eastern, nowadays...
Even Saudi Arabia for that matter.
Nowadays, there is, sourcing of oil is, those days of having favored terms, etc., long-term contracts, etc., are over.
Yeah.
So there is, other than an assured source of supply.
One last question, sir, on this. Now, I have some figures over here. MRPL had already expected to cut nearly 40%, according to of its Iranian imports as well, in the fiscal year ending March 31st. In the first 10 months of the current fiscal, like we've already told viewers, India reduced Iran crude imports by nearly 22%. Now, do you see imports from Iran being curtailed further, not just by refineries, but also by other companies, or even stopped altogether? Do you see that happening?
See, that is already happening, and that I think, as internationally the Iran problem grows,
and the pressure builds.
Indian refineries will have to reduce their dependence progressively.
No, we'll have to wait and watch really how far, how soon do they do that. We'll take another small break, so we'll come back with a third story of the week. Of course, the third story is about insurance regulator, IRDA, and traditional insurance plans. We'll come back after a small break. Don't go anywhere. Keep watching Policy Watch. Welcome back. Insurance regulator IRDA has tweaked norms for insurance companies to invest their funds in different market instruments like government securities and corporate debt to channelize long-term savings in the infrastructure sector. Life insurance companies can now be invested in central government securities, which should not be less than 25% of the total corpus. However, the total investment in central government securities, state government securities and other approved securities cannot be less than 50% taken together. On pension funds, the guidelines said that money generated from them will be invested in the government bonds up to 40% of the fund value, while not more than 60% would be invested in other approved instruments. As for investments in ULIP funds, the guidelines said that at least 30% of the fund value would be invested in government securities and 5% can be invested in housing, infrastructure bonds as well. So, the final guidelines that the IRDA had just issued now caps commissions for agents, also provides a minimum sum assured and guaranteed surrender value on traditional products sold by life insurers. Now, this is great news for the policyholder himself and consumers, but that could affect the margins of these companies, yes or no?
That's right. It will have an impact on the margin, but these guidelines were overdue. And
they've been pondering over them for quite a while.
It's right. And the insurance regulator has done, right to do that. The more interesting thing is about the investment guidelines it has come out with. Now, they have said that insurance companies can invest between 10 to 15%. In fact, 10, 12 and 15%, depending on the size of their investable assets.
Right.
Now, there, if you look at it, LIC, the bone of contention had been whether LIC should be allowed to invest 30%, as high as 30%, which is what Finance Ministry wanted, because it has got a divestment program in SUTI and all that, where it would like LIC to pick up further stakes. Now, LIC is already reaching the ceiling with several of the blue chip companies, where SUTI is holding those shares. So, but I think the insurance regulator has stuck to certain principles by not letting it go beyond 15%. That is a good thing. Number one. But if you look at it, over the last 1 decade, in fact, when this debate of allowing private sector and foreign investors to come into insurance started, one of the basic goals was that these companies, insurance companies, would help infrastructure investment and mobilize intermediate long-term funds through infrastructure bonds, etc. And so their investment focus would be infrastructure. That hasn't happened. Over the 10 years, the experience also has been that the insurance penetration, that is, India is one of the least insured countries in the world, and that hasn't happened because of the kind of the insurance companies have gone in for some so-called toxic schemes, and some of the policy holders have burnt their fingers. So they haven't inspired that much of confidence. So the spread and penetration of insurance hasn't really. But
do you think these norms would perhaps ease that, and the penetration would increase?
That is right.
That is the idea.
Some of the consumer-friendly or the policyholder-friendly guidelines which have now come out should inspire, although it will put pressure on the margins.
I have one last question for you, sir, today about ULIPs. Now, if you remember 3 years ago in 2010, IRDA had come out with new norms, increasing the lock-in period for ULIPs, unit-linked insurance product, and lowering commissions on their scale. Now, this led to a massive dip in ULIP sales. Do you see the same fate for traditional products now, since the guidelines are similar for traditional insurance products now? Do you think that...
Well, that shouldn't happen.
But if it happens,
but if it happens, then insurance companies should just close their shop and go home. Because if you are not able to market traditional products, and you just want some kind of hybrid product which is not really insurance, because if you remember ULIP, where a minimum investment required from a subscriber was 3 years, is not a long-term product at all.
Right.
Insurance, by its nature, is supposed to be a long-term product.
Right.
And if insurance companies are unable to mop up long-term investment from subscribers and then channelize that into long-term investment for sectors like infrastructure.
But overall, a good move by of course, the idea. Long overdue norms, and
that's right.
On that note, sir, we'll have to end the show. We are running out of time. Many thanks, Mr. Dash, for coming on the set of Policy Watch again. That was Priyaranjan Dash, of course, managing editor of the Financial Chronicle. Our first story on Policy Watch this week: big joint venture between AirAsia, the budget carrier from Malaysia, and Tata Sons. They've got FIPB approval now. They will enter the Indian market, barring, of course, if DGCA puts any objection, which we hope it will not, for the sake of the aviation sector. Competition will liven up, and we hope it galvanizes that particular sector as well. Our second story on Policy Watch this week was, of course, that Indian refiners, especially MRPL and Hindustan Petroleum, might just very soon stop getting crude oil from Iran. Insurers are getting worried about it, and they don't want to risk their money when Western sanctions are on Iran right now. We'll have to wait and watch whether or not there's just a curtailment or a complete stop on Iran crude imports. Our third story on Policy Watch this week was IRDA tweaking norms for insurance companies that want to invest in government securities. It's a good move, and like my guest said, long overdue move. We'll have to wait and watch how that really affects that particular segment, the insurance sector. And my guest mentioned a very important thing, of course, that penetration or insurance penetration is still very low in India. We'll have to wait and watch whether these norms actually help that as well. That's all the time we have on Policy Watch this week. Athar Khan saying goodbye, good night, and thank you for watching.